Hey, Mike Coltharp here. I want to talk a little bit about tax deductions and specifically regarding your 401k or IRA, individual retirement account. Okay, so when I talk about 401k, those of you who have read my book, it includes the 401k, the 457, 403b, TSP plans for those who are working for the military. Any retirement account that you are putting money into now and you're going to pay taxes later. Those are called deferred retirement accounts. And a lot of people are not really clear on how the tax deduction works. Now, a tax deduction is like if you have real estate, right? And you're taking the deduction for the interest on the loan. Let's say you paid $10,000 in interest in your real estate loan last year, and you take the deduction on your taxes with your CPA. So that $10,000 you keep, okay? You're not paying taxes on that $10,000. When you put $10,000 into your 401k, you're not paying the $10,000 now, but you're going to pay it later. So it's not a deduction, it's a deferral. You're deferring that tax to a later date. And typically it's 20, 30 years down the line when you are ready to retire and you have a nice nest egg built up so that you can start enjoying your retirement. The problem that arises is that there's a lot of people, they start their 401k without even thinking about it because they're told by their employer. And they're like, okay, I got to have a 401k. My friend has a 401k. My family has a 401k. And so I better get a 401k to save for retirement. But nobody teaches you what that actually means and how it works, and that there are other options out there that will keep you or help you not have to worry about paying so many taxes. Now, there's an expert in the industry. He is a CPA. He's been doing it for 40 years. His name is Ed Slott. And one of the things that he said, and I'll quote, he says, taxpayers with the largest IRAs and their beneficiaries will be in a higher tax brackets in the near future. And what he means by that is a lot of people don't realize that they're told throughout their whole career that they're going to be in a lower tax bracket. The problem is these tax brackets get adjusted and increased. Also, because of RMDs, which are required minimum distributions, this is when you're actually forced to take money out of your account at a certain age. Typically, it's age 73, depending on how old you are, or you were when you started your 401k, or you will be when you do your RMDs. The laws have been changing, so there's a lot of differences, but typically 73 is now the RMD age. You turn 73, the IRS is now going to tell you how much money you have to take out of your 401k. That's a different video. So what I want to just make sure is clear today is that when you pay money into your 401k or your IRA, that is not a tax deduction, it is a tax deferral. So hopefully this was helpful information. And if you want to talk to me or have any questions about what I just discussed, go ahead and send me an email, respond back to this email, and we can get you on the calendar and I can answer any questions that you might have. Or you can talk to your CPA about it. But thank you for this time, and I will talk to you later.